Everyone, welcome to another explainer from the bull versus the bear. So if you've glanced at your portfolio lately, you've probably seen a whole lot of red. Yeah, it's been a pretty rough couple of weeks for investors. So today, we're going to dig into what's really driving the sell-off and, more importantly, what you need to be watching for this week.
All right, let's get right into it. Look, there's no sugarcoating it. The last 2 weeks have been absolutely brutal for the markets. We've seen a sea of red pretty much everywhere, and it's pretty clear the bears are firmly in the driver's seat right now.
And this isn't just a U.S. thing. Nope. What we're seeing is a coordinated global sell-off. From Wall Street to Frankfurt to Tokyo, everyone's hitting the sell button. It's a classic risk-off move across the board.
And this number? Wow. This just perfectly captures the mood out there. This is the VIX, what they call Wall Street's fear gauge, and it surged almost 13%. That's a huge spike, and it basically tells you just how much anxiety is flooding back into the market. So the million-dollar question is, why now? What's going on?
Okay, so reason number one. It looks like we're getting a serious reality check in the one area that's been propping everything up, the artificial intelligence sector. And to understand why this matters so much, you got to look at the sheer scale of it. AI-related stocks now make up a whopping 36% of the entire U.S. market. So you can imagine, when that part of the market catches a cold, the rest of the market doesn't just sneeze, it gets the flu. It's an earthquake. So what's happening is, after this unbelievable run, investors are starting to step back and ask, are these sky-high valuations really justified? There's this growing fear, that maybe the hype train went a little too fast. And you can see that pressure building on the big players, like market leader Nvidia, which is down more than 8% this month alone.
So the natural question is, right, is this just the dot-com bubble all over again? Well, maybe not exactly. The concerns about overinflated stock prices, yeah, that feels very familiar. But here's the key difference. Today's tech giants, your Nvidias and Microsofts, they have rock-solid balance sheets. They're making tons of money. That's a world away from a lot of those dot-com companies that had no real path to profitability.
Okay, so that's the AI piece. Now let's move on to reason number 2, because it's not just about tech. There's a whole lot of confusion and uncertainty swirling around the Federal Reserve and what they're going to do next with interest rates.
And this timeline, man, it just perfectly captures the whiplash investors are feeling. So at the end of October, the Fed cuts rates, and the market cheers. Awesome. But then, in just a couple of weeks, we get all these mixed signals from different Fed officials, and suddenly the probability of another rate cut in December has tanked. It's gone from over 60% down to basically a coin flip at 46%.
And here's why that matters so much. This kind of policy uncertainty, it basically paralyzes investors. Think about it. If you don't know what the cost of money is going to be, how can you confidently price any risk? You can't, especially for those high-growth tech stocks that are super sensitive to interest rates. So what you get is exactly what we're seeing, more volatility.
All right, and this brings us to our third big driver. And this one isn't just about Wall Street spreadsheets or fancy Fed statements. It's about the American consumer. And the signs are pretty clear. The main engine of the economy is starting to sputter.
I mean, just look at this chart. Consumer confidence plunged 6.2% in November. And when you dig into why, you see a really steep drop, 17%, in how people feel about their own personal finances right now. That is a massive red flag.
And this isn't just a survey number, okay? This anxiety is hitting the bottom line of major companies. You take a company like Home Depot, which is a great barometer for consumer spending, they just missed their profit targets for the third straight time. And what did they say? They pointed right at consumer anxiety and a slump in the housing market.
And believe me, that housing slump they mentioned, it's real. First-time home buyers now make up just 20% of the entire market. To give you some perspective on that, that's the lowest level we've seen since 1981. 1981.
Okay, so let's pull this all together. You've got shaky AI valuations, a Federal Reserve that nobody can figure out, and a consumer who's getting really, really nervous. Where does the market go from here?
Well, it looks like the entire battle between the bulls and the bears could come down to two huge make-or-break events happening this week.
First up, on Wednesday, we get earnings from the big one, Nvidia. This is a real-time test of that whole AI story we were just talking about. Their numbers, and more importantly, their forward guidance, could either pour gasoline on the AI fire, or it could pour cold water on it and confirm the market's worst fears.
Then, on Thursday, we get the delayed jobs report. This is the other massive piece of the puzzle. It's one of the key data points the Fed is watching. Here's the simple breakdown.
A weak report might actually be good for stocks because it could push the Fed to cut rates. But a strong report, that could kill any hope of a rate cut, and the market would not like that at all.
So, this all boils down to the ultimate question that every investor is asking right now, and it really gets to the heart of the bull versus bear debate. Is what we're seeing just a healthy correction, a way to wash out some of the speculation, or is this the start of a much deeper downturn because the economy is genuinely weakening? Look, understanding these big picture drivers is absolutely crucial for navigating what's coming next. And if you want to see how these big forces play out for individual stocks, that's what we do here at the Bull versus the Bear. So make sure you subscribe to the channel and check out our other videos where we break down the bull and bear case for specific companies. Thanks for watching.